During this long, prolonged cycle of below average performance, in various forms we've accumulated debt. It's household debt, corporate debt, and many countries also fiscal debt. And so our belief is that that's just an unusual cycle and that we're converging back to a normal economic performance, and that'll give us a period during which those debts will, relative at least to the size of the economy, will recede in importance. So a bit of a normalization of that. Will debt still be there in 10 years? Yes, it will be. But the sustainability of it will improve through time as the economy grows at its potential rate. And but how it affects policy today is just taking it into account. Knowing it's there means understanding when interest rates are normalizing, they'll have a bigger effect on underlying behavior than they otherwise would. And so you have to take that into account in terms of pacing and understanding where your destination is.
One of the markets we watch in Canada, particularly for the economic knockover, is the housing market.
Yes.
And we have seen an effect of new regulations. Is it enough? Are you satisfied that we've found kind of a stable place?
I think it's a little early to make that conclusion. And we know when we had a year and a half ago, we had the changes in the Vancouver market, and there was an initial effect and then a bounce back. And that just shows you that Mother Nature is still there, you know, that the fundamentals for housing remain quite strong. And I think the same thing is there in Toronto. That's what it looks like. There's very, very strong fundamentals. This was never about controlling prices or the housing market. It was about improving the quality of indebtedness to make it more sustainable. And by all counts, that's looking like that is moving in the right direction. We'll have a lot more to say about that next week when we put out the FSR, but it's encouraging. But as judging the new rules around mortgages versus slightly higher interest rates and the net or the total impact on housing, it's simply too early to sort them out. We'll need more data.
In terms of the risks in the world, what's the biggest thing you're watching right now that might affect the Canadian economy?
Well, trade risk. The risk around NAFTA or actions taken outside of NAFTA. At a minimum, just the discussion of it for the last 18 months has got everybody's radar on full, and companies postponing or delaying important decisions or making decisions that are different, investing in the United States or what have you, just to hedge against the risks that present. And unfortunately, these are decisions that only come up once every few years. They're highly strategic decisions for a company. So if we lose an investment because of that, well, we're not going to get that investment back just because NAFTA gets cleared up. It'll be an opportunity lost. So we've identified an effect already, even though NAFTA still is in effect, on the economy due to that.
There is some evidence that our manufacturing base in Canada is running close to capacity.
Yes.
Now is the time for new investment.
Right.
Is the risk that that investment doesn't happen because of all of these uncertainties?
Yes, there's a risk of that, and we have anecdotes, companies that have told us that they aren't. And yet at the same time, the investment numbers have been pretty good. Actually, the latest ones this week were quite good. And imports of machinery equipment, which is another important indicator, are also very strong. And the sentiment indicators have been good. So what that tells us is that companies are getting on with it on average. The anecdotes that are negative, of course, stand out in those conversations. But it suggests only that investment is lower than it otherwise would be, but still is making a significant contribution to growth. So encouraging that underneath that we still have the usual forces acting and in a positive way. So we have to wait and see just how this